Now, digital assets are poised to play a major role in the evolution of global financial systems, with fintechs, banks and industry groups all looking at how the digital currency ecosystem is unfolding.
Now, strategic alignment around interoperability and operational excellence can help drive a secure, scalable and innovation-ready financial ecosystem.
To discuss this in more detail, earlier we spoke to Ather Williams, Executive Vice President, Head of Global Payments and Liquidity and Wholesale Digital at Wells Fargo, and began by asking him what recent changes he sees in this area.
Well, I think the first thing that's really changed is you've had, by country, so in the US most recently we've had the Genius Act, but in countries in Asia and in Europe, you're having a set of regulation and legislation come out, which is sort of set the rules and boundaries around who can issue what type of instrument and set the roles and responsibilities of the parties playing in the ecosystem, which was a critical next step so that banks and other fintechs can start figuring out who's going to do what to whom and how we're going to drive which use cases. I think the other thing that's come is the technology is continuing to evolve. Just like we've seen in other things like artificial intelligence, the acceleration has been massive. So when we started this conversation almost a decade ago around distributed ledger, the real question was it scalable? Can it handle the volume and scale that we have in current payment systems? And I think as the technologies continue to evolve, you've seen it get more robust, more resilient. There are still things we have to work through, but we think the institutional power is there to now add it to the global financial system.
Ather, the big question we have to ask you, how do you see digital currencies actually evolving in the market, and what role will banks actually play in all of this?
Well, I think the world we see going forward is going to have two things. We have to separate the infrastructure from the instruments. So the infrastructure, where we think about what we do with SWIFT and the 11,000 banks in SWIFT, or we think about in a country where you have real-time payments networks, you may have a low-value payment system like an ACH in the US, et cetera. All those things still exist. And so I think the future of the world thinks about that infrastructure and what we're going to add to that to bring more capabilities. So when I think about what digital ledger brings, you get things like programmability. So the ability to create a smart contract around a payment. And you think about use cases like buying a home. It's a combination of you need a title that's usually paper held in some municipality. You have a contract around the terms of that buy, and then you have to bring in the financing. All those on-chain can happen together. The algorithm around the smart contract can make the decision, and it can atomically settle. Those things will create a lot of efficiency in that particular use case. So that's the infrastructure. Then you have the instruments. The thing we have to sort of work through are who's issuing what. Because across the spectrum of digital currencies, you have the pure cryptocurrencies, which are largely investments today. Then you have stablecoins, which have been, there's two dominant ones that are backed by HQLA. And then you have the emergence of tokenized deposits, so taking central bank money and bringing it in token form and bringing it on-chain. All those different instruments have different uses, and there's different risk profiles, and depending on the customers you're dealing with, they'll want to interact with them differently.
Can you share some insights perhaps with us about what you're hearing from your clients from an interest and adoption perspective?
Yeah, so most of my clients are companies. So I think about everything from small businesses to the largest global companies in the world. And what treasurers and CFOs would tell us is that they don't really want to deal with new infrastructure. Stop making us understand how payments are made, but we want the benefits. We want efficiency. We want to be able to atomically settle. We want to be freed from the confines of different bank operating hours. New York's open, Tokyo's closed, Dubai's open on Sunday, New York's closed. How do I get around that? They love the programmability so they can say, hey, I can work across my network, and when conditions are met, I can move money. Those things they're really excited about. What they're concerned about are the risks. If you think about what's the fungibility between coins? They also don't want to deal with every bank issuing their own coin, and they have to figure out how to value them, how to manage the risk and hedge. So it's up to the industry, ourselves and our partners in the infrastructure, to figure out how we're going to create interoperability so we don't go back to the world. And I think about the US pre-1870 when you had each bank issuing its own notes, and then you had to figure out whether or not you wanted to take that note as currency. That's why they created the Bureau of Engraving and Printing in the US, so we had one national currency. We're kind of going back to that if we start issuing our own coins and tokens. So we have to start think that through carefully and understand how they're going to interoperate, and that'll be the key breakthrough that'll allow this really to scale.
Now, there are multiple groups, fintechs, banks, industry players, all looking at the digital currency ecosystem. As this matures, do you see one type of network ultimately dominating, or is it in fact a multi-network future? Is that going to be inevitable?
I really think we're planning for a multi-network future because the network should be comprised of individual banks who have large global footprints, who are going to have networks within their own companies to move money across their individual entities. You're going to have networks based on consumer use cases, where you have some high volatility currency countries where people want to hold dollar-based stablecoins, and they're going to trade on one network. And then you're going to have bank consortiums or other consortiums that connect. The key thing is how we're going to find the interoperability between all these networks. So we're planning for a future where whatever our clients want to do in the digital world, on an on-chain world, that we can help them manage through that network. The other thing we have to think about is the world's not 100% on-chain. So we're going to have to go on-chain and off-chain. We're going to live in this hybrid world for quite a while. And so how can we use the benefits of getting things on-chain, but then settle back into fiat currency where people actually want to pay out and actually get hard cash?
And looking at where we are right now with digital currencies, where do you see the near-term use cases and opportunities we can get involved in 2025?
Yeah, so again, I spend most of my time talking to companies. And so there are really two key use cases we're focused on at Wells Fargo. The first is cross-border payments. So thinking about how we can improve on what we have in correspondent banking. The thing is, people forget that they look at some of the edge cases, but correspondent banking is not really broken. When you think about it, 75% of payments that go cross-border settle within an hour, and like 90+% settle within a day. So it's really the edge cases, and most of those stop for real reasons. Is it fraud? Is it a sanctions-controlled payment, or other things that there should be some friction in the system? However, we do recognize that there is opportunity to create greater transparency, greater connectivity, and if you can get it down faster and makes sense, that's great. So cross-border payments is number one. Number two is really thinking about for our largest global corporate clients who are of multiple entities, and they've got subsidiaries in hundreds of countries and multiple currencies, they're usually functional in a few. And so they have a very clunky process internally where they're trying to repatriate cash, move things back to their core functional currencies. Being able to automate that through digital currency could be fascinating. It could be faster, more economically efficient for them, both from a fee structure, but also create a lot of liquidity value. So that's the other use case we're pursuing.
Well, thank you so much for joining us here in the wonderful Sibos studio. Lots ahead, lots of sessions to come, but thank you so much for flying all the way from New York to catch up on all the action. That was Ather Williams, Executive Vice President, Head of Global Payments and Liquidity and Wholesale Digital at Wells Fargo.